Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, Phil Mackintosh, Chief Economist at Nasdaq, Tiffany Wade, Senior Portfolio Manager at Columbia Threadneedle, and Chris Wolfe, President and CIO of Pennington Partners. We're here to discuss the state of the markets heading into the fourth quarter and where the headwinds and tailwinds lie. It is great to have all of you with us. Full boat this afternoon. Chris, we will kick it off with you. There's a number of moving parts in the market. Just got the rate cut, so of course we're going to parse through that over the next couple of market sessions. What are your thoughts as we're heading into the last quarter of the year already?
I think this is pretty bullish. 25 basis points feels about right, number one. Number two, it gives the Fed a little bit more room to observe the flow-through effects for tariffs. They're kind of percolating through. Some interesting things about tariffs is that not all companies absorb them all at once. They kind of pass them through at various points in time. So I'd expect the inflation pressure to just kind of be slow and subtle through 2026. So the Fed not being overly aggressive right now is a good move, I think. I think the other piece of the puzzle is you're in a place where we have pretty good economic growth so far, and we have a lot of incentives in the HR One Big Beautiful Bill Act that are all about investing in the United States. And so, we have a lot of fiscal policy and potentially monetary policy arrows pointing the same way. That's usually pretty good for stocks.
Yeah, I guess, Tiffany, the question is, now that we've got the 25 basis points, was that priced in with markets sitting at all-time highs?
Yeah, I think that was as expected for the day. Pretty well telegraphed, certainly, from Jackson Hole. And then also, if you look at the dot plots, it's not too far off from where the market was expecting rates to go for the rest of the year. Dot plots are a little bit more hawkish than I think where the Fed funds futures were, but not too far off. But I think what's also interesting is what the 10-year was doing. So it initially sold off. And maybe the market was keying on Powell's comments about the jobs market being a little bit weaker, tariffs maybe having impact on the jobs market. But it's bounced a little bit. So I think, to your point, there's a lot of good news in the economy right now, a lot of stimulus to come. And maybe that, tells us that we're not that worried about the jobs outlook or the economy for the rest of the year.
Yeah, and Phil, what's your perception of this?
I mean, I kind of wish we'd had rate cuts at least a couple of meetings ago, because you look at how much of the small caps income has been getting chewed up by interest rates. It's been close to 50%, which is like the highest level it's been for the whole century so far. So small cap companies are really been hurting. They've been paying pretty high interest rates on all their debt. There's a lot of refinancing to do so. I mean, the 10-year is going to be important because that's a lot of their refinancing benchmark rate. We want them to be able to refinance cheaper so that the small companies can take advantage of some of the fiscal stimulus, build factories, start to grow as well. And I think it's good as a start. If you think about, inflation's well under 3% now. Demographics are kind of aging. I don't think we need an interest rate above 4 in a neutral environment. And we are pretty neutral, right? Because the labor market's weak and inflation's pretty much under control.
Is 25 basis points enough, though?
No, I don't think it is.
Is it like a moving needle for the small?
I wouldn't have wanted to see 50 today, because I think the market would have panicked a little bit. They probably would have second guessed why we would have got a 50. So 25 is right, but I wish we'd kind of followed the rest of the world and all the other central banks and just kept cutting through the cycle. Because I think you're right. Like the tariffs aren't having that much inflationary effect yet. We only import 10% of the GDP, and the tariff rates are 10 or 15%. So maybe it's a 1 and a 1.5% one-time price shift. It's not like what we saw with COVID when inflation was up 7 or 8%.
Yeah, I still think the consumer can digest.
They have been, but the question is which consumer is spending, right? Higher income consumers are the ones that have been carrying the load for so long and continue to carry the load. Lower income consumers are really struggling here. They're trading down, doing without, and the middle income's getting hurt. That middle level, under 150,000 annually, depending where you live, is really kind of a diminishing group. And they're trading down as well. The Walmart call a couple of weeks ago was kind of very instrumental in pointing it out to a lot of people. They're seeing people trading down, it's higher income coming in. So the question is, who's going to keep spending? If higher income continues to spend, then there's status quo. If you see a downturn there, it could be very recessionary.
Yeah, and I guess we have to go back to...
Not what you wanted to hear.
Well, no, I mean, it's to Phil's point, okay, we got what we wanted,
right?
But was it really...
No,
the timing of it was, what's it really going to do to move the needle is my question.
You're going to get 2 more cuts by the end of this year, in all likelihood, depending on what happens. At a quarter point, basis point. haven't had a chance to parse through everything like everyone said
Right.
here. But that's a big tick down. And if we get another 2 cuts next year, then now you're talking about financing on a corporate level at a reasonable rate where companies can actually put that money to work. You're talking about interest rates coming down with mortgages. The housing market starts to move. A lot of good fundamental economic change starts to happen internally here, but we can't get there until the interest rates come down across the board.
It's super rare for the Fed to go, oops, my bad, we cut 25, let's hike again. Something has to go wrong.
Right.
So I think a lot of folks are just going to shift to the end game, which is, hey, what's the terminal rate? Where do we need to be? Is it 3? Is it 250? A lot of that's going to depend on inflation, but the path might matter a little, but we know we're going down. So that's going to change the way companies think about the financing piece, how they interpret HR1 and how they're going to look at investing next year. So lower cost of money definitely helps the small caps, but before we get overly bullish, I think there's a great point that Chris made. The idea here is that the wealth effect matters a lot, so the stock market's maybe the higher income folks are spending, but we might be wildly underestimating some things like food price inflation, because that's where the lower income folks tend to get hurt a lot, and changes in food price inflation are really difficult to reverse.
Yeah, especially when you have to remember that the market is one thing and the economy is the other. And we're sitting here with markets at all-time highs, and perhaps, as a consumer, you're not necessarily feeling that same euphoria when you're going to the food store. So it's almost
different consumers are probably feeling different layers of different levels, of euphoria right now. If you're a business owner, this looks really good.
Yeah, but speaking of markets at all-time highs, though, Tiffany, it's been a concentration that has been moving the indexes, right? So it's going to come back to, we're seeing some broadening out within the market, but again, there's a handful of companies that have really been the main drivers for sentiment.
Yeah, that's absolutely true. It's been the mega cap tech stocks. AI has been the story for this year. Those names have really driven the market higher. But honestly, I think we continue to like those names, and the reason is that it's earnings that have driven those names higher. So, there's concern about valuation in the market. There's concern about valuation for those stocks because they've really been leading the market. But those stocks are up because of earnings, not because valuation has expanded. And that's not the case if you look at the rest of the market, where it's been mostly valuation expansion for the year. So we actually still feel very good about those names. There's more visibility if you think about names that are tied to the AI trade. And we're starting to see, inflection in use cases for AI that I think will continue to drive that.
Yeah, Chris, we spoke about that last week, right? Where we know the companies, the NVIDIAs of the world, Microsoft, Amazon's, all the ones that create this AI and so forth. But now we're starting to understand the ROI and the use cases of companies that are adapting that technology. And I think that's where the story is.
Right, it's a broadening base. If you go back to COVID and any other type of situation, you've always had a base case of large cap or mega cap companies that have led and pulled the markets along with them. Right, coming out of COVID, it was, a handful of stocks. Now you got the AI case, you've added a couple of more stocks to it, but they're all the mega cap. Those companies compose 40%, give or take, of the S&P 500 if you look at the market cap weighted, not the equal weight. So they continue to grow. You're seeing utilities doing very well on top of, even though that sank a little bit here. You're seeing infrastructure build out for data centers, companies doing very well. And on the use case for all the other companies, people are still unsure. We're still very, very baby steps into it, and how consumer companies, restaurants, et cetera, pick your poison, knows how to actually integrate AI in a productive way at the moment. Right now, there's so many different players, it feels a little bit like the dot-com bubble because you're not sure which way it's going to go. There's going to be winners, you just don't know which ones they're going to be yet.
Yeah, I think we're seeing that the productivity story is still in its very early days. It seems like technology companies are obviously adopting AI faster. That's where we might see it first. Financial services like banks, cards, that's somewhere else we might see it as well. Marketing, advertising, content creation, I think, is another area. But there's been some surveys recently, asking corporates how they feel about, how far along they are in their AI journey. And I think it was 5% of them feel like they have a good implementation plan for AI. A lot of companies are still figuring it out.
Yeah. But think about it though, Phil, the spending is really propping up the economy at this point. It's not necessarily, the consumer 70% of GDP and so forth, but it's really the surge in AI spending that's propping the economy.
To Chris's point, it's spending on data centers, it's spending on buying the NVIDIA chips. It's not the productivity changes where suddenly your costs go down and so your margins go up. So I think, at some point the companies using AI to make their businesses more efficient, like roboticization of the industrial complex 50 years ago. So you look at the industrial complex, we used to have 1 in 4 jobs was manufacturing. Now it's less than 1 in 10, but we have not changed the amount of output that comes from the manufacturing sector. We've automated factories. this is going to kind of do the same thing to a lot of white-collar jobs. We're going to automate a lot of work. We're going to be able to do more with less people, which has its own social costs potentially,
Right.
but that's a big productivity gain. And so that's really where I think a lot of companies we're not talking about yet will suddenly have their costs go down, margins go up, profits go up.
So back to the labor picture, though, perhaps we're not seeing hiring because we're not quite sure what to hire for.
I think
it's
that
more
might actually,
conjecture than
I think that might be more of a tariff story, having talked to the companies that I've been meeting. They're not, the companies aren't sure yet whether they need to build a factory in America or move a factory across borders or change their supply chain until they know what the tariffs are, how the lay of the land is going to be, what their new cost base looks like, how many customers want to buy at the new cost. And so I think at the moment that a lot of the corporates are kind of like, well, I'm just going to wait and see until I know my tariff story.
Right.
And so on the manufacturing side especially, the corporates have kind of just stopped hiring.
Tariffs are tricky. There's a non-trivial probability that the refunds might have to move from Customs and Border Protection back out. And you got to keep in mind that the tariff story also has a 314-day cure period. Customs and Border Protection has 300 days to evaluate what you brought in and pay tariffs on. And if it wasn't enough, they can go back and seek redress, or they can give you a refund. So there's a lot of elements to the way that you would think tariffs affect the corporations that ultimately have to pay them, I think is the first piece. But I think the other thing that's related to tariffs is that, look, many companies that decided to outsource to China and manufacture there did it for global reasons. They're selling to Europe, South America. They're not going to move from China. Why? It's very difficult to transplant all of the infrastructure you put in place to sell globally from China if you're a U.S. multinational and bring it back to the U.S. That's not a one-time decision. And the uncertainty isn't about the policy for the next 2 months. It's about the next 10 years, like the recovery time for putting a new factory here.
Yeah, and that's really what the challenge is, because it seems as if policy is shifting each time we have a new administration, which, I mean, it could change the entire trade picture.
So here's the flywheel with AI. At that point, what's the easy decision? I'm going to put as much into AI and tech as I can to preserve my margin, cash flow, give myself, if I'm running a company, as much flexibility as possible. And it's great in terms of productivity. I totally agree with your story. If you can distribute the functions that we historically kind of centered on one person, quick example. Does anybody know Python here? It's a software code.
Yeah.
Like you had to learn it. It's like another language. Imagine not having to learn it, but just going into an AI engine saying, do this for me, that you would have had to know how to code. All that goes away now. You can distribute productivity enhancing functions in a lot of places. As simple as making a PowerPoint a lot easier, for example, to as complicated as I need to assemble 27 different points of data relative to, a single entry point, and I need to have it all in some common format. That's the power of it.
Well, and that is why you see the unemployment rate significantly higher within the population just graduating from schools for that reason, because a lot of that is entry level. And what do we tell kids?
Learn prompting and scripting.
Learn how to code,
Gotta.
comp sci, and you'll write your ticket everywhere, right? So 5-6 years ago, when you're going to college and you're thinking about this is how you...
Maybe not anymore. I mean, that statistic you're talking about is particularly bad for men, not for women coming out of university. So there's obviously a different set of interests maybe
Right.
in the mix between what men are coming out. Like engineers, I guess, typically are a lot more men. Women are doing different types of topics, and the women are finding jobs much more easily than the men coming out of college.
Yeah, it is interesting. I think demographics in general are going to be quite impactful to the economy moving forward. Whether you're talking about population decline,
Yeah.
The makeup of the workforce and so forth.
Yeah, I mean, as the population ages, we're going to need more people in healthcare and those kinds of services, and maybe less people building houses. I mean, you look at the China story with its population and all of its real estate problems now. Like, has it overbuilt so much that some of those apartments might never get used because its population's shrinking already? And there's one continent in the world that's having enough babies to grow the population, and it's Africa. So, basically the whole world's population, at some point when we stop getting better at getting older, is going to start to shrink.
Yeah, someone's going to have to pay for Social Security, and there's not going to be anyone.
AI going to be doing the work too.
Yeah, I was going to say they'll be doing the work there as well. So, Hannah, if you think about this longer term and what your outlook is into the end of the year, moving forward into 2026, I mean, do you stay the course, or are making any moves, or is there even a reason to?
Yeah, I mean, I think Chris made a really great point about the outlook for the economy for the rest of the year. There's stimulus coming from the tax bill that should be a nice tailwind. Obviously, the start of a rate cutting cycle is also a nice tailwind. So I think there's a lot of reasons to be optimistic through the end of the year. So we're staying the course. And as I said before, we still think that a lot of the names related to the AI trade are going to be winners.
Right, and we will leave it on a positive note. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.